Guys, Google stock is up 33% year to date. Only 33%. Poor guys, they've been too slow on the AI front. They're a dinosaur now. This is a company that was selling for 150 plus. If you look at our past videos, we said we liked it under 100. People said there's no way it goes below 100. And November 3rd of last year, it was at $83.34. Just a few weeks ago, it hit 129.04. All-time high, February of 2022, 151. So look at this, guys. All-time high, 151 in February. November, 9 months later, fell to 83 bucks. So remember, even great companies will fall. And it's rebounded, but it took a massive, magnificent 7 AI boom to get this company to go up from $83 a share up to $129. A great 50% increase. That's awesome, over 50%. But what we're trying to do here on this channel is we're trying to look at companies. We're not trying to look at stocks and say when you buy a stock, you're buying a piece of a business, and every investment is the present value of all future cash flow. So if you're a beginner investor or an experienced investor, we have something for you in this entire video. We're going to go over analyst estimates, our 8 pillars. We're going to go over bull cases, bear cases, and then we're going to put the company in our stock analyzer tool, make assumptions about the future, make assumptions about those future cash flows, and it'll tell us what price to pay for the company today to get the returns we want to get. All right? Yep. So this is a big thing for our channel. We're very big on being value investors. We want to sit there and look at a company and make sure the noise behind. Mo, what were you just saying about AI, the criticism of Google about AI?
Criticism of Google, they're saying that they were too slow to get into the game and now they're too fast.
What does that mean, they're too fast?
Don't know. I'm going to read it real quick. And we're also going to put the link to the article in here.
That's incredible. Okay, so some high-level things while Mo reads it. Market cap, 1.51 trillion. That's if you buy every share outstanding in the market at market price. Now, enterprise value happens to be the exact same thing. So what does that mean? Essentially, there's no debt in the company when you factor in the cash. This is awesome, guys. It's very, very difficult for a company to go out of business if it has low debts or has enough cash to cover all of its debts. That's what's awesome. All right? A couple other things. No dividend. Makes sense. They think they're a high-growing company. They probably are. 1-year PE of 25.8, 5-year PE of 30.6. All right? Seems a little rich. Mm-hmm. However, for a company like Google, which has a very big moat,
very big,
a very high return. Oh, I'm actually surprised by the return on invested capital.
Same here.
Wow. I think I catch this by surprise every time we do a video about Google. I thought this would have been higher.
I did too. I thought it was going to be rivaling Apple.
Oh, I didn't think it was going to be that. I thought it was going to be Microsoft level of mid-20s.
Mid-20s, yeah.
What this is basically saying, guys, is Google does a good job. The market average is 9 or 10%. So they do a good job of getting a return on the money that's invested in the business, right? This is an indication of a moat. You want to pay a premium for a company that has a good and increasing return on invested capital, as well as some growth potential. Those are the two factors when you talk about what premium to pay for the company. So I don't know if this is too high for Google. Might not be. I really don't have a clue. But we can use the art of investing to determine what premium to pay for the company based on these. So Mo, what'd you find in that article?
So basically what this person is saying is that, let's see, it's right here. So they were going into the AI space very slowly, and now they're starting to integrate AI into their own search engine stuff, and they're saying that it could end up eating their bread and butter, which is their advertising business.
See, I would have thought the exact opposite. I would have thought it would help the advertising business.
I thought it would definitely maybe streamline it.
Make it more efficient.
Exactly.
You know, I do love, talk about Google. If you've ever done Google AdWords, you know how beautiful the product. They want to reward you by charging you less the more relevant your website is. So literally, when you Google something, 85% of the clicks go in the first 3 ads, the first 3 links. Spoiler alert, the first 3 links are all ads.
Exactly.
Because Google wants to control that. But it's not possible for them to look at every single ad and every single website. So what they do is they look at your website through the crawler or something. And the more relevant your site is to the keywords that are found, the less money you'll pay for an ad. It is very, very possible that the person on the first ad line pays less than the second and third person. Because if this is a highly relevant search, Google's so big on the customer satisfaction, the customer experience is so important to Google that they're going to reward somebody. It's an inverse relationship. The more relevant your website is to what you're advertising for, the less you're going to pay. Imagine that. They're rewarding you by giving you the top spot for less money.
Being better and more efficient.
Yeah, because they don't want you to, let me go to extreme. They don't want you to look up, kitchen forks and all of a sudden a porn site comes up. I don't think they don't even allow you to advertise porn sites, but you get my point. They don't want that to happen. So the way they do it is they do it that way. So that way the people who are the most efficient, the most relevant are going to pay the least amount of money. And that's a brilliant business model. Mm-hmm. It makes the experience for the user so much better.
And keeps them coming back.
It
makes them not go to Bing.com.
Or Ask Jeeves or DuckDuckGo. Yeah. Is that Apple's?
Yeah, I was actually looking at this here. So
shame on you.
85.5%. They have
look, DuckDuckGo.
85.5%. DuckDuckGo has a whopping 0.74% of the market. Bing is 8.3, Yahoo 2.4. It's incredible.
Bing's probably skyrocketed a lot lately.
It probably has.
All right, so before we get into bull and bear cases, let's look at the 8 pillars. Oh, actually, let's go to this first. Gross margin, 55%. This means every dollar that comes in the business, 55 cents goes basically to the bottom line before taxes. Every extra dollar, And a bottom line margin of 23% over the last 5 years. And 20.6% last year. So margins are down a little bit. Okay, they're cutting costs. We've seen that around all the tech companies. So let's go check out these 8 pillars. Remember, guys, if you're part of our software, you can customize the 8 pillars up to 12 of your pillars and 4 quadrillion different variations. So sign up for the software. More on that in just a little bit. But here are the 8 pillars. We got check marks all around, except for the 2 valuation metrics. A 32 5-year price to free cash flow and a 30.6 5-year PE ratio. So again, is this expensive? Guys, let me explain it this way. I don't know if it's expensive. I would ask you that if 2 companies were exactly the same and one was growing 20% a year and one was growing 5% a year, which one would you pay more money for? Clearly the one that has 20% growth. Everything else the same. So that's the idea here is we don't, in and of itself, this says, maybe it's a little expensive, but if they have a lot of growth potential and a high return on invested capital that they can reinvest back in, maybe it's not expensive. All right, Mo, tell us some bull and bear cases for Google.
So one thing I want to, as we're on the 8 pillars, they're buying back shares a lot. They're buying back shares, and they've been buying back shares for quite some time, even quarter to quarter. I checked that.
So $83 a share, the PE was sub 20.
That was good.
All day.
I like that. Yeah. But in 2022, they announced a $70 billion buyback program.
So look at their free cash flow. $47 billion average in the last 5 years, $62 billion last year. Mm-hmm. You kind of go like, what are they going to do with the money?
Yeah.
They're not paying a dividend for a reason.
Not paying a dividend, right.
All right, keep going.
Expanding into cloud partnerships, and I think this is a good idea because they are trailing Amazon Web Service and Microsoft's Azure. So they have right now 10% of the market share, Amazon Web Service 32%, Azure 23%. So it is good that they're starting to get into that area. And they're doing stuff with verifications for mobile payments, and especially in that AI space and whatnot. They are starting to get into games on YouTube.
Yeah, I heard about this.
The gaming area, which is a great idea.
I heard about this.
It's just another area that they can go into. Bear cases. U.S. is suing them over antitrust stuff. Of course, it's always going on. I like those things. I don't really take too much weight into.
Yeah, the bigger you are, the better you do, the more they're going to concern you're going to abuse that. Mm-hmm. Peter Thiel, he has a theory that monopolies are better for consumers because monopolies don't want to lose their monopoly. That's his theory. Yeah. In his book 0 to 1, that's essentially his idea. It's like, listen, if you have a lot of competition, it depresses margins. When you depress margins, you don't get reinvestment. Yeah. When you have a monopoly, they want to stay a monopoly, they have higher margins, they're going to reinvest back more. In theory, that sounds really good.
Yeah.
Right?
Yeah.
In theory, that sounds really good.
Yeah.
One thing that's interesting, the top 2 search engines in the world are Google and YouTube, both owned by Google.
Right.
So just remember that.
Right.
YouTube on its own is the number 2 search engine in the world.
Right.
They don't include that in there.
No, they don't. And actually, I found a bear case that was talking about how they are lagging in the web services area, but in the bull cases, it's insane. So it's all the bull cases and bear cases, guys. It's perception. It's how you look at these things. That's when I read these on the channel. I want you to just make sure you're thinking a bull case for one person could be a bear for somebody else, and vice versa. So
yeah, it's all perception, and the bull and bear cases will follow the stock price.
100%.
That's the other thing.
100%.
So what that means is, guys, When the stock is falling, people are going to accentuate the bear cases even more. When the stock is going up, it's, oh my God, look how great this is. Prime example, go look at Meta in the last year and a half. Last year. In November, it was $83, and this is $88. This is the worst thing ever. This is terrible, blah, 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 blah. Now, all of a sudden, Zuckerberg's a genius. He's great. Let's go fight Elon Musk.
Yeah, they said he had lost his touch as a CEO, and he should step down 8 months ago.
Yeah, cool. All right, let's go look at analyst estimates. Now, we have these on our site, but of course, we encourage you to take these with caution. But they're expected to make $5.20 a share this year, going to $9.70 in 4 years.
Okay.
All right, so that's pretty good growth, Mo.
Yeah.
Definitely in the double digits.
Yep.
All right, what about revenue growth?
High single digits?
High single digits?
Yeah.
307 to 441. Again, guys, we have these on our site for our users, and we put them on there as a reference point. But remember, these analysts have the same bias. It's probably even worse than you do because they have career risk. Yeah. They can't be too far from each other. All right? Now, let's go to the stock analyzer tool. So remember, of all of our tools here on the site, we have all these tools here. Stock Analyzer was used 1.3 million times last year by our users. We have thousands of users in this community who talk every day. I see screenshots of the Stock Analyzer tool. All of this is available, everythingmoney.com, $7 for 7 days, $1 per day. Just go there, check it out. It will change the way in which you view money. This is your future financially. Is it worth $1 a day investment? Absolutely. So we're going to make our assumptions using a 10-year analysis. And in our tools, you can do up to 20 years here. 1 to 20 years. We do 10. Sometimes I'll do 20. Past videos I've done 20, but I think we found that people want us to do 10-year analysis more. So Mo, look at this. An increasing ROIC.
Yeah.
All right, that's good. That's good. So the first line, guys, revenue growth percentage. Mo, what kind of revenue growth do you want to do low, middle, and high for Google for the next 10 years?
I kind of want to do 4, 8, and 12.
Love it.
Okay.
So what this means, guys, he's saying, listen, let's say all these bets don't really work out, blah, blah. They're still going to probably grow their revenue by 4% a year because internet growth is going to happen, GDP, et cetera. But if they hit on all cylinders, maybe they can get 12% a year.
Yeah.
I mean, the analysts seem to think in the next 5 years they can get high single digits, so maybe they crush it in 10 years, they can do 12.
Right.
The point about this is pick a high number that's still hard to get to, but at least attainable if things work out.
Right.
And the middle number should probably be where you think it's going to happen. All right, profit margin.
What do you think about 19, 22, and 25?
Let's do it.
Okay.
What about free cash flow?
I think the same. Theirs are very, very consistent on both.
I think 19 is still very, very low. But
I do too.
That's okay, though, because if we beat it up,
yeah,
we're going to account for it here at the bottom when I get there.
Right.
Now, PE. Guys, the current PE is 25. The current price of free cash flow is 24. Don't base your PE and price of free cash flow based on where it is today. My recommendation is historical average is 15 to 16. Start there. And as ROIC and revenue growth are higher, you increase your PE. If they're lower, you decrease your PE. Remember, Warren Buffett bought Coke at a 30 PE in 1987 because he said, this moat's insane. And yes, I might not make 15%, but this is a very stable company that'll be around forever. I'm okay making. And guess what? With dividends, he's made about 11.5% since 1987.
That's pretty good.
Yeah. On a very stable business.
Stable, yeah. It's consistent across the board.
So what PE are you going to put in, Mo?
I was thinking 16, 18, and 20. I could justify a little higher too.
Probably could.
I mean,
why don't we do 16, 19, and 22?
Okay. They own 85% of the internet.
All right. Now, desired return. Guys, this is your margin of safety. The lower your assumptions, the less margin of safety to take. You put a lower return in here. You can get 9 or 10% from the market. Maybe you put in whatever number it is, but a number you sit there and say, I've already beaten the stock up. But as you go higher in your assumptions, they're less likely to happen. You need a higher desired return because it drives the price down further. The more return, the less price you pay. Just think about that logically. If you pay $100 for this phone and it's worth $1,000, you're going to make far more money as a percentage than if you pay $900 for it.
Right.
Same idea here. So Mo, give me your desired returns.
10, 12, and 14%.
I love it. And we've been doing that a lot lately on the big companies, guys, because to us, we think the next 10 years are going to be tough for the overall market. So this is probably not even going to happen for the overall market. So I'm okay making that for Google.
Yeah.
So guys, I'm going to hit the analyze button. Number's going to pop up. Here's what's going to pop up. Prices based on earnings and free cash flow on what price needs to be paid to get these returns based on these assumptions. And the third row of numbers will be if you paid today's price and this happens, what your return will be. this happens, what your return will be, and this happens. So it's better to tell you, hey, go buy it today. And if these things happen, here are your returns.
Yep.
Scroll down. We have a low price of 67, high price of 150, middle price of 100.
Okay.
If you paid today's price, 2.5% of your low assumptions occur, almost 10% of your high middle assumptions occur, and 17% of your high assumptions occur.
Crush it.
So I have it on my watch list at 85. I'm actually going to change that.
Mine's at 105.
Yeah, I'm going to put it at 100.
Okay.
Notify me. Guys, look at my watch list. This is another great part of our website. My watch list, it'll notify you whenever the stock hits the price you want through email, through the phone app, and through the computer. No brainer, guys. $1 a day. Go to everythingmoney.com. Check it out. I guarantee it'll change the way in which you look at money. Thank you for your time.